Hello, it's Gene Tunney here. Welcome to this episode of Economics Explored Live. It's Friday the 5th of November, and as usual, I'd like to review the big economic news of the week, or at least what I think is the big economic news of the week. Obviously, we can't cover everything. I'm keen to keep this concise and wrap it up in about 20 to 30 minutes. So we'll go over what I see as some of the big news stories. Okay. So the first thing I want to cover is this story that has come out in the last 24 hours about the Biden White House and how the White House is pushing OPEC, the OPEC plus countries, so Saudi Arabia and other oil producers that are allied with Saudi Arabia, and also Russia, the OPEC plus group. The White House is encouraging them to increase oil output, and they're saying that if they don't, then that risks imperiling economic recovery. That's how the Financial Times out of London has reported it. And look, I mean, there could be some justification for this. I mean, we've spoken about that's probably not a good view there. Let me try that view. We've spoken about the high oil price before. So oil prices has been increasing, and that's flowing through to petrol prices. Still not as high as it has been in some previous periods. So the White House could have some justification. And there's also, based on the data that I've got, I'll show you this chart here. That's a chart of oil and gas total oil supply. And so that may be a month or two old, that latest data point. It's monthly data that I've got access to. And that still is lower than that pre-COVID level. So, the US is trying to encourage those countries to increase their oil output and try to bring down the prices as supply increases. Now, look, this could be a bit of a distraction from the White House. The White House could be trying to distract journalists from the fact that, I mean, the US has got a range of issues. There's the supply chain crisis, or what people are saying is a crisis, that the White House has been accused of not acting on. Well, I mean, what could they do really? It's a function of this great disruption that's occurred because of the pandemic, so it's unclear exactly what the administration could do. That's one issue. There's also all the political trouble that the administration is over there, and you saw the results in particularly Virginia, where the Republican Party had a very strong result, and so it looks like the Democratic Party is in trouble over there. So who knows? I mean, this could be part of that. But look, there could be something to the story. So I thought that was an important bit of news and something that's worth taking note of. Okay, the next thing I think is interesting, and again, I've picked this up from the Financial Times, the world's greatest financial and economics newspaper, without a doubt. And they've been reporting, and this is something that we've probably been expecting for a while, given the emerging inflationary pressures worldwide. It's been reported that the Federal Reserve, so the United States Central Bank, or rather a network of banks, the Federal Reserve banks, together they're the US Central Bank. The Fed is to start winding back $120 billion a month stimulus program. So this is that quantitative easing, as they call it, where the Fed is creating new money electronically and using it to buy assets or bonds, and it's adding to its balance sheet. So I've got a chart up there of the balance sheet of the Federal Reserve banks. So Federal Reserve Bank in New York and all the others throughout the country. And look, you just see just how that's grown with all of that quantitative easing, that money printing, and those asset purchases. And I mean, it's much. I mean, look at that. It's 8 to 9 times what it was prior to the financial crisis in the late 2000s. So the way I've looked at it is this is it's an extraordinary experiment in monetary policy that central banks such as the Federal Reserve, the Bank of England, Bank of Japan, European Central Bank, and now our own Reserve Bank of Australia have been running. And we're starting to see concerns that it could be inflationary because ultimately it does result in an increase in the money supply, and we know that inflation is ultimately a monetary phenomenon. So that is it's justified that the Federal Reserve should be looking at winding back. And we've also seen news this week that our Reserve Bank of Australia it's abandoning its what it's called, or what some people have characterised as yield curve control, where it's been trying to target I think it was the 3-year bond rate, if I'm remembering that correctly. So yes, it's a yield curve target. There was a good piece that Stephen Kirchner prepared on his Substack, and I'll put a link to that, where he writes, RIP, RBA, YCT, yield curve targeting, lived dangerously, died young. The RBA bowed to the inevitable this week and abandoned its yield curve target, although Governor Lowe continues to maintain that an increase in the official cash rate is unlikely much before 2024, given it doesn't see core inflation well established in the midpoint of the target range until the end of 2023. We'll chat more about that in a moment, because we've seen some extraordinary house price figures come out this week, and we know that there's that inflationary pressure, and there are some economists who are speculating that interest rates could rise earlier than that. Okay. Ooh. I think that's Tim Hughes joining us on the live stream. He'll be hopping on soon. He's my colleague at Adept Economics. Tim, good to have you on.
Morning, Gene. Pleased to be here, mate. Terrible traffic today.
Oh, that's okay. I was a bit late in starting myself, so it gives me a chance to take a break.
Cool. Where are we up to?
I was just chatting about some of the news around oil and how the US, so the Biden administration, is encouraging OPEC, Saudi Arabia, allies of Saudi Arabia, Russia, to increase oil production. We've chatted about the oil price before and implications of that, and they're concerned that it could affect their economic recovery from COVID. What I was trying to say is that I think there could be it could be a political distraction, because the Biden administration is in all sorts of trouble with the supply chain concerns in the States. I mean, probably largely out of its control, really. And also there were recent elections, the election for the governor of Virginia. I don't know if you saw that news.
Yeah, so didn't go with the Democrats.
No, that's right. So, big win for the Republican Party there. So that will be of concern to the Biden administration and
for sure,
and the Democrats in Congress. Okay, so I think we might be up to Aussie property prices, and I was just talking about this before because there's a lot of debate about when interest rates could rise in Australia, and I think I'm probably more sympathetic to the people who are arguing that they're going to rise sooner rather than later, even possibly late next year, or early 2023. And that's because we just see this extraordinary growth in property prices, and also there's the inflationary pressure. I'm just going to take these. I've got these ear monitors in, and they're just. I've got to get a better setup for that. They're a bit frustrating. Brisbane is leading the way in terms of property prices. We see this growth rate of 2.5% in the month of October. So, right, okay, so imagine annualizing that, and that's a pretty crazy growth rate, okay? And so this made news, and partly this is related to, well, there's all of the credit creation that's occurring across the country, all the people borrowing to get into housing, and there's fear of missing out and all of that. But there's also the interstate migration. Queensland is a net gainer of people from other states through interstate migration. And there are all those stories about how locals are getting outbid at auctions by people from interstate who are just buying sight unseen. I mean, they might have buyers agents. They're increasingly popular. So Brisbane is leading the way in monthly terms. And as I said, if you think about, well, what does that mean on an annual basis? Well, look, it's just getting ridiculous, okay? And we're talking through the year growth rates of 20 to 30%, okay? Units less so, particularly in Brisbane here, where in the past we've had an oversupply of units, so units have only gone up about 10%, but house prices 25% through the year, so from October 2020 to October 21, and overall dwellings, about 22% or so. So you've got this extraordinary growth rate in house prices that just surprised a lot of observers. I mean, some people got it right. I mean, people like Cameron Murray saw this coming, but the majority of commentators didn't expect this at all. So it's quite extraordinary. But it's got to do with, in hindsight, it makes a lot more sense because of all of the low interest rates and the quantitative easing, all the additional money, all of the borrowing, the credit creation that adds to money supply. So, yeah, really extraordinary numbers. These are the figures in regional areas. Also, actually, I'll have to adjust my layout here because
Gene, do we know if this has been the case around the world, or is this unique to Australia?
Yeah, it's happening around the world, Tim. Yeah. I'll have to put some charts up of the US and UK next time, but yeah, we definitely know that this is happening around the world.
Similar kind of percentage jumps?
I don't know whether they've exceeded 20%, but yeah, some of them are definitely in the double digits. So let me get back to you on that.
I've got a couple of questions on this, Gene, when you're ready.
Yeah. I'm just trying to figure out the best way to set this out. I thought last week it seemed to work full screen layout. Let's try that one. But then you don't see me. Okay. I better stop playing around with that. Fire some questions, Tim.
Yeah, a couple of things. I mean, so clearly this kind of growth isn't good, I would suggest. I mean, it makes it very difficult. Like panic and fear aren't good good drivers in any kind of market, although even, of course, in financial markets that happens all the time. But with housing, it's a very emotional thing. People need somewhere to live at some point, whether they rent or buy. For those who aren't on the housing ladder, it makes it a very stressful situation. You hear of people who've been looking week in, week out, almost getting somewhere, falling short. For every house that gets sold, there are many willing buyers who miss out. So it's a very stressful situation, especially when you see these increases. People can see that if they miss out, the longer they miss out for, the more expensive their house is eventually going to be, etc. What intervention would there be to try and stabilise this from the government?
Okay, well, I think we have to think about what interventions are sensible. Look, I think a lot of what we've seen, this huge build-up in demand, all this extra credit, I think that's a lot of that has been driven by Reserve Bank monetary policy, by the Reserve Bank really pushing interest rates down and essentially encouraging banks to lend. And so all of this extra credit is is facilitating this. So that's one aspect of it in the short term. But look, there's also, I mean, in Sydney and Melbourne, there's been some commentators have been saying that property prices are much higher than you could really justify compared with comparable cities around the world. Because I might go back to Sydney. Hang on.
Just on that, Jim, because with the low interest rates, would you say that was overcooked, that they should have maybe come up sooner? If this is a result, because these increases are they're only good for people who have more than one property, you would say. If you're on the property ladder, then you're protected because you're going to buy and sell at comparative rates. But it's driving, obviously, it favours the people who have investment properties because that's where the real gains would be made, I guess. But more than anything, it's the people who are getting left behind who aren't on the property ladder, where it's extremely stressful to see these kind of figures in any situation.
Yep. So the Reserve Bank was mainly concerned about the state of the economy and the rate of inflation. So what they're trying to do is to ensure that the economy keeps going on a nice, steady upward trajectory. So they're looking at GDP. They're also looking at inflation. So they want that growth without inflation getting out of control. They're looking at CPI inflation. They're saying that they don't care about house prices. That's not a target of theirs, and that's APRA's issue.
This is a byproduct of the bigger picture.
Exactly. Yeah. And so what they're saying is the Reserve Bank, they're saying, well, it's APRA's job, the Australian Prudential Regulation Authority's job now to do these macro-prudential measures, and they're starting to implement some of those whereby they've increased the buffer by which you have to be able to service a loan. So I think it's going to have a marginal impact on the maximum amount people could borrow. It's not, they could go a lot further, and possibly they will, because particularly with growth rates of this magnitude. Now, one thing I would say, Tim, is you've made a good point. I mean, look, this is difficult. If you're trying to buy a house, the market could be sending you a signal, though. One way to look at this is that the market's sending you a signal that now's not a good time to buy a house because prices are so high and renting's a better option. So if we look at a chart of the rental yields, we see that these are relatively low, particularly compared with what they would be historically. I mean, these should be up around 5 or 6%, and they are in Darwin. But if you look in Sydney, I mean, your gross rental yield is 2 to 3%, depending on the property type. And in Melbourne, for houses, 2.5% or whatever that is. So the market is essentially sending a signal that, well, renting's actually cheap relative. It's a cheap option relative to buying a property. So there should be some equilibrium there in terms of what economists call the user cost of housing, or there should be some balance eventually between, so that it should be relatively, you should be indifferent between renting and owning if the market comes into balance. But look, that's a difficult argument to make, because because clearly there are benefits in owning your own home, and you don't want to be in a situation where you get to retirement and you don't own your own home, because that's going to be very difficult for you. So that could be cold comfort that the market is sending the signal that it's cheaper to rent relative to buying at the moment.
I mean, ultimately it's supply and demand, isn't it? That would be in a free market. If people are willing to pay X for anything, then that's the market value as such. Historically, when we've seen these big jumps in the past, they might settle, they might go down a fraction, but they never over time decrease. So this seems to be setting a benchmark for what we can expect to be paying for housing into the future.
It's not that they never decrease. I mean, certainly you look at what happened in the United States after the financial crisis, there was a big drop in property prices there. And in fact, I mean, that you saw people walking away from houses because they ended up in a negative equity situation. Yeah. And in Australia, around 1990, we had a drop in house prices because of the recession then. So it's not as if they can't fall.
Yeah.
They can fall. But if the economy keeps growing and people keep employed and there's still access to credit and people are feeling exuberant about housing, then sure, it could keep rising. And there's a debate at the moment about, well, when will this moderate? And there are some people in the markets, I mean, people like Pete Wargin, he's a good person to follow. He's saying he expects strong growth to continue through 2022.
So one of the takeaways for this, I mean, would be if this isn't a buyer's market, if people are looking to invest their money somewhere, then maybe they can to increase their overall wealth and then come back to the property market as and when they can afford to or be in a position to do it. So this clearly is not a great time to try and buy. But if, like you say, if it's been forecast to grow into next year, it's going to keep that FOMO and that pressure on would-be home buyers for some time longer.
Yeah, exactly. So I think we'll have to wait and see what happens with interest rates, what happens with these macro-prudential measures. I think if you're watching this, I think I may have accidentally cut off Tim's audio before because I've been trying to show the full chart without it being obscured by this image of me.
Was that the censor again? Am I swearing again, Gene?
No. I just took us out of the stream. I'm still a bit of a rookie with the StreamYard. But the city you can't see that's obscured by the box with me in it is Adelaide, in case you're interested. Okay, so that's a bit of a chat about property. And the other thing I wanted to cover today was retail turnover. There are just some. The rental yields are a bit better in regional areas, so the property prices haven't gone up as much there relative to rents as they have in the city. Or they're not as high relative to rents, I should say, because we have still seen some decent growth in some of those regional areas. Particularly, what's interesting is Tasmania's done so well. So both Hobart and regional Tassie. There was a chart earlier I had that showed those places, and I think there's a real Tassie's really got an attractive lifestyle. People want to move there. Yeah. Okay, so we'll just finish up with this. This is retail turnover. This came out yesterday from the ABS for September quarter, and no surprises, big drops in New South Wales, nearly a 12% drop in retail turnover that September quarter because of the lockdown. Similarly, you had a substantial drop in Victoria, nearly 5%. Queensland was pretty much flat. I think, if I remember, about 0.2% increase in real turnover. Now, that should probably have been higher, but we did have a couple of mini lockdowns, and there's also the impact from interstate border restrictions that's possibly been constraining that. But look, the general message is lockdowns cost your economy. Of course, you have to think about what the counterfactual is. I mean, some people would argue that if you have the lockdown, then that prevents something worse happening. Look, who knows? Difficult to assess that. I think we'll be arguing about COVID measures for decades in the future. But I thought I'd just show that just to illustrate that impact of the lockdowns. But as we discussed last week, there have been very strong vacancy figures, so we should expect the economy to snap back very nicely. So, Tim, that's all I really wanted to cover today. Any other questions or thoughts?
One other question I had, I was going to ask you about the housing market was, I know in parts of Asia, it's not unusual for there to be 3 generational loans, so 75-year mortgages. It's not something we've seen here in Australia as yet. As I understand it, I think 30 years is about as long as you can take out a mortgage for. Would that be a good idea, or is there some reason why that hasn't happened here?
Well, because we haven't had property prices at the truly insane levels that you've seen in parts of London or New York City or Tokyo. I mean,
So-
that's the issue, right? I mean,
Yeah.
if you did end up with, some of those townhouses in London, in Mayfair or Kensington or Belgravia, they go, what are they, £100 million or something ridiculous?
Well, on current trends, Brisbane's heading that way, by the look of it. I mean, so for instance, I mean, instead of going to a 75-year loan or whatever, so to keep this within perspective, because like these, this is the comparison that gets drawn amongst the annual wage and the affordability of homes has the cost of housing has exponentially got way outgrown the growth of wages. So 40 or 50-year mortgages. What is there something that stops these kind of things becoming available? Because clearly at the moment that would make it more affordable for people to buy a house. Not that it would make the situation any better, but it would open up the market to people who are already being left behind. Any thoughts on that?
I'm not sure what you're driving at there, Tim, or whether that is actually the barrier. I mean, the big barrier, I think, is what Graham Young calls the deposit gap.
Yeah.
So it's the fact that you're going to have some sort of down payment. I mean, the banks want you to put up, I mean, depending on your situation and depending on whether you've got a guarantor, I mean, you're going to need at least 5%, but then you have to pay for mortgage insurance, I think, if I'm remembering correctly. But generally 20%.
To avoid mortgage insurance, I think 20%.
Sorry, if you only put up 5%, then you would have to pay mortgage insurance. Yeah, I phrased it incorrectly.
No, it's okay. I mean, it's a lot of money regardless if you're going to save up that at this stage.
And if you're self-employed, I think you generally have to put up about 20%. And so I think that's what's stopping the people who can't get in. It's that reason. I mean, if you can meet that, if you can get over that hurdle, then the banks will lend you the money. I don't think it's the term of the loan that is the issue here.
But the repayments, for instance, I mean, so the repayments on a 30-year mortgage are going to be higher than a 50-year mortgage. So I haven't seen those become available as products. So I just wondered if there was a reason for that.
What I'm saying, Tim, is I don't think that's the hurdle, because I think given how low interest rates are at the moment in this country, anyone's going to be able to meet, they should be able to service that, the payments for a 30-year mortgage. There's just I don't think that's the issue. I think the big issue people have is getting that deposit. That's the real issue. This is what Graham Young calls the deposit gap.
Yeah.
Graham's done some really good calculations. So he puts out this housing affordability report through his Australian Institute for Progress, and he shows that given how low interest rates are, that it's actually quite affordable, or it has been quite affordable to buy a house. I mean, now we've got prices increasing, so that's decreasing affordability, obviously. The big issue from his perspective is the deposit gap. But let me come back to that, Tim. That's an interesting question about those longer term mortgages. I mean, my feeling is that's just because you're talking about property which is just insanely overpriced in the major, the international, the global cities in London or New York City or Tokyo, right? It's that's not Brisbane.
One day, my friend. One day, mate. One day.
Post-Olympics.
Oh, yes.
The new world city.
Yeah. Just watch this space.
Oh, one other thing, Tim, before we go. One thing I think governments should be thinking about in terms of measures to improve affordability, and this is not going to be an overnight fix, because if you think about how long it would take to redevelop a lot of these areas, we should be looking at all of those restrictions on supply, zoning rules, which mean that we can't redevelop inner cities or the character suburbs. One of my colleagues and friends, Brad Rogers, he wrote a good piece on my Queensland Economy Watch blog, 7 or 8 years ago, old Queenslanders in a new city, where he was talking about how we've got these rules which mean you can't knock down and replace these old Queenslanders and old workers' cottages on reasonable sized blocks of land, you can't, provide townhouses or medium density. And we're not talking, you don't necessarily have to provide high density, but what we've got, say, in Brisbane here is because of the restrictions that the council imposes, there are some areas that the state government has declared priority development areas, and we've got former light commercial areas or light industrial areas, such as Milton, where you've got all the high rises going up, or Wollongabba.
Yeah.
So you've got some areas where we've got all of these high rises, and I don't know. I don't think that's a great way to live. I'd rather have more medium-sized developments, townhouses, and I think we could really increase density with townhouses in our inner city suburbs or suburbs sort of on the periphery of the inner city.
I guess every city would have a mixture anyway, wouldn't it? Like emanating from the centre outwards, generally the higher buildings in the middle and getting slightly lower as you get out towards the burbs.
Yeah, but we've got much lower density here in Brisbane and
For sure.
than even in Sydney
Sydney
than
and
compared with
Melbourne.
Sydney or Melbourne,
Yeah.
and definitely compared with New York or London. Of course, we're much lower density.
We
than
complain
there.
about rush hour here, and it's like 15, 20 minutes into the city from most places, which for cities around the world is a hop, skip, and a jump. Like it's pretty close.
Yeah, it depends on where you're coming from. That's pretty good if you can get into the city in Brisbane in 15 to 20 minutes. Some people are half an hour, an hour.
Yeah.
Depends.
There are still a lot of people commuting over longer distances and longer times, but comparatively, we're pretty lucky here in Brisbane compared to most.
Absolutely. Okay, we better wrap up, Tim.
On that note, we're lucky.
Good stuff. Okay, thanks for watching. And check out the show notes for links to articles I mentioned, and hope to do this again next week and catch up with you then. Thank you.